All right, welcome in, everybody. Hope you're having a wonderful, wonderful Thursday. I think it is Thursday. And I can't believe it. The dog, the new puppy, the golden doodle, rang the bell a while ago. I mean, it really was fascinating. I told Beth, I said, Beth, open the door. The dog rang the bell. I got excited. The dog said he had to go outside, so he rang the bell. Unbelievable that dogs are that smart. I mean, I knew they were that smart, but I've never had smart animals. Mine are all kind of, challenged. Is kind of what I would say. So kind of cool. So now I've got my let's see, I've got my IRA over here now. So y'all can see we got $116,000 in two IRAs, and I think there's 3,000 in the Roth. There's I don't know, there's not, most of it is in a regular IRA. So what I'm thinking about doing, it's kind of cool, right? We can do anything with it. But what I'm thinking about doing is this. So what y'all think about this? Let's get our little notes together. Since we can play here. Isn't it great that we can make our decisions and all different kind of things? Let me yeah, Matt, you told me it'd work, man. I ain't lying. I was skeptical. But I mean, the dogs are smart. Now, if I get my cats to do something interesting, because I've got some stupid cats. All right, so let's look and see what we can do with this cat. So we got here's what I'm really thinking about. Oh, what's wrong with my little Jadooja Badooji? Hold on. My little thing over here. And then let me get my other little thing over here. And then let me fix my little tablet. Yeah, I mean, animals are smart, I've never had a smart animal. Most of mine just, I see the neighbor's dog, like he likes to throw balls and he catches them in the air. And I'm like, this is the smartest dog. Of course, he kills my chickens. I'm like, this dude is smart. But then I have to run him off because he, kills my chickens. Let's get this thing working area. Let's see, where do we need this at? Not that one, we need it on this one. There we go. Now let's see if we can work. So we got about $116,000. Here's what I was thinking about doing with it. And I've had this thought for a while of running FHEA in it. I think that'd be cool. That way I really wouldn't have to worry about, options trades or anything. Does anybody know what HFEA is? Anybody? Bueller. Nobody? All right, if you'll Google it, HFEA, it'll come up. It stands for Hedge Fundies Excellent Adventure. Excellent Adventure. And some dude that calls himself Hedge Fundy kind of came up with this. And I kind of like it. So what he does, here's what he does. He puts 55% of the portfolio into UPRO. You don't know what UPRO is? It's the 3x leveraged S&P, right? So that's pretty much what it is. 3 times leveraged S&P 500. So if the S&P 500 goes up 1%, this thing goes up 3%. So he did 55% UPRO. Then he does 45% of our old friend TMF, the 3 times leveraged, what is it, 20-year treasury? Right. So that's what that is. And then what he does is he does a quarterly rebalance. So that's kind of cool. Now I got to tell you, there's a part of me that wants to just go 100% into TQQQ. So I just think that's one of the things that I'm looking at. So I don't know exactly what I'll do. I thought about last night. I was hoping when the CPI number or whatever come out today, I was hoping it was going to be devastating and the market would just crash. It'd be a great day to whop into UPRO. So one of the big things is this: do I take my 116,000 and do I just go in all at once and just do my 55% UPRO and my 45% TMF? If that's the way I'm going to go, and just do it all at once. Keep in mind, a lot of people think that dollar cost averaging is the way to go, right? Because they go, well, it's less risk. Well, it is less risk if the market goes down. If the market goes up, which it normally does, it's more risk, because instead of buying it all today at a lower price, you're going to be averaging in at higher prices. So what was the statistic I read yesterday? 66% of the time, lump summing is better than dollar cost averaging into something. So a lot of people just poo-poo on dollar cost average. Now, dollar cost averaging is really, really good if you don't have a pile of money, right? So if you've got 500 a month to put in, well, that's exactly what you do, is you go in and you do 500 a month because you don't have the pool of money. But if you've got, the pool of money, sometimes it's hard just to go, I'm all in, baby. I'm going all in on my allocation. Now, when we talk about the Lacello algorithm and we talk about AIM, everybody needs to remember this. AIM is nothing more than a rebalancing mechanism. That's all this is. Where you take profits from some, and then you put money into the others that are kind of underperforming, and that's really what that is. So if you say, well, I could do AIM, that's a rebalance, or you could do quarterly rebalance and forget about it. Now, what does a quarterly rebalance do? Let's think about that. So if we're 55-45, equities to bonds, and then the next month we're 60-40, equities to bonds, what does that mean? Well, that means your equities have performed well. So you're going to take off 5% of those, right? So they were winners, and you're going to do the same thing that Lacello tells us to do. You're going to take winners off and reallocate back to your starting 55-45. And then, since these are only 40%, you're going to be taking that cash and buying more of these. So selling these, selling the equities, and buying the bonds so that you keep that allocation. So that's just it's just another way of skinning the cat. You could do the AIM, or you could do quarterly rebalancing or monthly rebalancing, or and there's a lot of studies and talks out there about when is the best time to rebalance. Is it quarterly? Is it monthly? Is it annually? Is it biannually? Is it never? Is it daily? Is it constantly? There's a lot of talk out there and a lot of chatter, and you just find something that you're comfortable with. So if it's an IRA account and you go, I'm not going to be doing a lot of options trading in there, just going to, hold shares, maybe do some covered calls, then, you can keep it really simple. And then how often do you want to check in on it? Quarterly sounds good, right? If you think about most Americans, that's probably a stretch for even most Americans. Because basically everybody puts money into their 401k and then never does anything with it. They just keep on going until the market crashes and they get out and go to safety. But some of them are even too lazy to do that. So we kind of do want a lazy man's portfolio to see that. So I think one of the accounts is 113,000. I think the other one's 3,000. On that 3,000 one, that's probably what I should do, is just buy all TQQQ and just never look at it until 10, 20 years later. So I don't know. Be interesting to see how we do that and what we pull out with that. So really, really cool stuff to think about what we're going to do. So I need to think for a second. And I've never been one to take long in making my decisions, but it's kind of fun that, we'll be starting this together and just kind of looking at an IRA and a Roth IRA. And I don't want to really do a lot in. I just want to kind of set it up and then let her work. Let time do its thing. Because remember, there's, acquiring wealth and attaining wealth is really two things. It's math and it's behavior. And the math is pretty simple, right? We put money in, we let assets increase in value, and we, let compounding do its thing. So the math is the really simple part. We don't have to worry about the math. Math just kind of does what the math does. So the behavior is where we have the problem. And you got to have the discipline to put money away. And if you're 22 years old, fresh out of college, and you got your new job, you want to go out on the scene every so many off days, so you got to make sure that you got money to go to the entertainment venues and to the bars and to the restaurants and to the night dances and all those clubs. So you're sitting there going, well, hey, why wait till I'm old and can't enjoy my money? So I'm just going to use it now. So what I'd encourage you to do, if anyone here is young enough that they're, at that first job, the best advice I can give you is to please max out your 401k to the amount at least that is matched by your employer. So if your employer matches your first 3% that you put in 100%, that's 100% return on your money. It's just foolish for you not to do that. And if you'll do that from a very early age, then you'll never miss that money. And that's the honest God's truth. It's just when you get to relying on that money that creates a problem. So I don't want you cutting a check every week or every month into your retirement accounts. You need to get that set up automatically through payroll deduction, through, if you got a Roth IRA, do it through automatic withdrawals from or transfers from your bank account to your investment account. You've got to get it set up to where it's automatic so that there's no decision on your part. Because if there's a decision on your part, then what happens is, well, this month I'm a little slack. Can't put away all that money. I'm telling you, you start it, you never forget it. So then what if let's say your employer matches 100% on the first 3% and then 50% on the next 2% that you put in? Y'all, that's a 50% return on your money on that second 2%. You would be foolish not to put the entire 5% into your 401k. So you got to do that to at least take advantage of your matching. So hopefully you've got a plan like that with your employer. I had one throughout my career. I always maxed it out. I always did really well with it. Now the problem becomes is all of a sudden, you get $50,000 in there or $100,000, and then you want to take money out to buy a ski boat or a bass boat or a cabin in the mountains. No. Leave that alone. Leave it alone. Don't mess with it. So it's the discipline to put the money aside. And then it's the discipline to know when to take profits and when to leave the money. And that's where we go with either the AIM or another rebalancing. I hate to call it a scheme, but it is a scheme. Scheme. How you spell scheme? Scheme. Right? It's a scheme. It's a rebalancing scheme. So set it and forget it. Now, for those of you that don't want to hit a lot of buttons, having to buy and sell and to rebalance, then you probably should consider going with a brokerage like M1 Finance, because they have these little rebalancing pies, and you can say, yeah, I want to be 55 UPRO and 45 this. And then it's just a matter of hitting a button at any time and it'll rebalance. And the cool thing about like an M1 Finance, and I'm speaking from what I've heard, not from personal experience, because I don't have any money with M1 Finance, but I think they allow you to do fractional shares, which is cool too, right? So you say a share of whatever you're buying is $100. Well, say you've got $105 in. Well, you can buy one share. Well, what happens to that $5? They allow that $5 to still be put into that instrument, into that underlying, which is kind of cool. So an M1 finance would probably be kind of cool. You just hit a button and it automatically rebalance everything for you. But the first thing is you got to have the discipline to put the money away. You got to have the discipline. The math kind of takes care of itself. We've got math taken care of with a spreadsheet with AIM. We've also built in, if you don't want to do AIM, we built in that you can do the rebalance. And we've built that into the spreadsheet. So our spreadsheet can be used either as AIM and rebalancing or just as rebalancing. Or we've also built in the twin vest if you want to kind of do a dollar cost averaging in, right? Dollar cost averaging. What is dollar cost averaging? That's where you put the same amount of money in on a, like I say, a monthly basis, right? 500 a month. And you don't care what the underlying price is, you're going to buy it at whatever the price is. So Lacello's twin vest gives us a little better way to do that, I think. And so you can read about that in Lacello's book as well. But it's kind of cool that you've got all these options. Now, the problem is if we give ourselves too many options, then we make this complicated, and it's really not complicated. This is not complicated at all, right? We want to keep it simple. Simple. And what does simple mean? Well, simple means, what is your plan? Okay, I'm going to put $500 into my retirement account every month, and I'm going to buy XYZ in such and such allocation, 55, 45, or whatever, and go with it. Now, how many assets do you need in your portfolio? You know, I would say probably 3 or less. Because I know what you're wanting to do. So you're going to want to put gold in there, silver, and oil, natural gas, equities, bonds, and then you'll put the euro in there. And you're just trying to keep yourself diversified. Diversification is overrated. Diversification is overrated. What does that mean? That means if you get 12 asset classes in your portfolio, I can about guarantee you that you are going to not outperform the market. Now, you'll have some of these little things that will be outperforming, and some of them won't. So that's why I say diversification is overrated, because you're going to water your portfolio down enough that you're not going to make anything. And if that's fine with you because you don't like having large drawdowns, things like that, then I got it. So I think history will tell us that you've got to have exposure to equities. Right? You just got to. The great Warren Buffett tells us this. He says, really for most Americans, all you got to do is put your money in the S&P 500. It gives you the 500 largest American companies. And that's it. And then just kind of dollar cost average into that. And that's an excellent plan. And you go, well, that's not diversified enough because it's only one asset class, the American giant corporation. I hate to tell you, but over the long term, the American giant corporation is going to be just fine. Just fine. So if you're young and you want to just start out, well, do that. Just put your money into the S&P 500 and, wait for 30 years. And one day you'll wake up and you're a multi-millionaire. It happens before you know it. So then we try to complicate it, though. And when we go, well, we got to have bonds in there too, don't we, Bob? Yeah. And then we need something else. What would your other one be? Some people say gold. scratch gold. So really, I'd say you need no more than 3 assets within your portfolio. S&P 500 bonds, and if you want a third one, well, how about a little cash on the side? Never hurts to have a little cash to buy when one of these goes really down significantly. All right, so what the hedge funding excellent adventure does, it says, hey, what's this? So I'm going to take what is traditionally a 60-40, you know how they'll say, well, you need to be in 60 equities and 40 bonds, and it kind of puts that on steroids. So it goes, what's this? I'm going to put 55% into UPRO, which is 3 times the S&P 500. So rather than having 55% equity exposure, it's kind of like you having, what's 3 times 55? 3 times 55 is 165. 165% equities. It's on steroids, right? And 45% bonds, because 45, but then they're triple X leverage. So what's 3 times 45? 35, that's 135% exposure to the bonds. And if you'll do a little search on that, you can see how they back tested it and everything, and how it, does really good with quarterly rebalancing. So you wouldn't even need to put in Lacello's aim in there. You just quarterly rebalance, which is effectively doing the same thing that Lacello would tell us to do, just rebalance. I kind of like that. Now, keep in mind, this is a wee bit on the risky side, y'all. Anytime you're putting in leveraged ETFs, it's a little bit risky. But how many lives do you have on this earth? Last I counted, I'm not a Shirley MacLaine fan. I don't believe that I'm coming back as a kangaroo. So I got one chance. Looks like we made it. I got one life to live here on this earth. So I don't mind taking risk. So many, how many of you know somebody that always just put their money into a bank account and they stuffed it in the mattresses, and they may have had a lot of cash, but what they could have had they had some exposure to equities, to stocks. So I know you think that you're God's gift to stock picking, and you're probably going to, you say, hey, I'm gonna pick Apple and Amazon and all that. Why? Why would you have to worry about Facebook dropping like it dropped over the last week? Who would want that? Who would want Netflix dropping like it's been dropping? Everyone's poo-pooing on Netflix and Facebook. Why do you care about that? Why, concentrate yourself into 5 or 6 stocks? Just stop it. It's insanity. When we've got all these great little indexes that we can put our money in, indices. So it really, really is simple. You got to take risk. It's math. It's discipline. Are you familiar with a 401a? Yeah, I've heard of a 401a. It's different, but the same, right? You got your 403bs, you got your there's all these kind of things. Whatever it is, and if there's a match, take advantage of it. All right. Now, if you don't have that, or if you do, still, I think a Roth IRA is the way to go, right? Even if you got a 401k, because theoretically, all your earnings on that is going to be tax-free one day, unless Nancy Pelosi lives to be another 30 years and she decides she wants to take all of our money for her, for her ill-gotten stuff that she's up to. So, put the money away, let the math do it, and get you some risk, and don't overthink it. Don't overtrade it. That's where we get in trouble. I told you I've been guilty myself. Don't overtrade. Don't overtrade. Just pick you some assets, because here's the thing. You're not stock pickers. Okay? This is not where your money is going to be made. You are not going to make money as a stock picker. That is a losing proposition. Where you make your money is as an asset allocator. Let's go allocator. asset allocator. That's where you make your money. So you're going to have some exposure to equities. Now, if you've got a portfolio and all you're doing is soybeans and lean hogs, pork bellies, cotton and wheat and all that kind of stuff, nah, I'm sorry. You may outperform the market for a year, but over the long term, you're going to underperform the S&P 500. It's just brutal fact. So buy the stock market. There are markets, there are funds out there that will equal the entire market. Like you can buy the entire stock market with just one fund. Buy that, hold that over your investment career. But this is where the money is made, asset allocator. And you better believe somewhere you better have the S&P 500 somewhere within your investment portfolio. It's very, very, very important. Now, if you want to double your leverage on that or triple your leverage, play with triple leverage stuff, you're taking an extra level of risk that is not necessarily, they don't match in the 401a. Yeah, that's terrible. What do they let you invest in, man? So what's the purpose of being in it? Why would that be better than you doing your own Roth IRA? I'd have to look up the 401a. I don't remember all that. Not sure. I mean, they're probably going to give you a some type of defined benefit at the conclusion of your career or something. So who knows what they're doing with that. But really, here's where the money's made, Jess. Asset allocation. And you can try to pick out the best stock, or you can try to pick out the best bonds or the best fund or the best this or that. And it's just futile by trying to pick stocks. What you need to do is allocate assets. And over the history of our nation, clearly, equities, stocks, is where you got to be. I have a separate Roth that used to be pension. So you got to have equity exposure. That's what you got to do. Equities. So much more important than bonds. In other words, if you were going to do just one thing, do the S&P 500. Now, by me wanting to do hedge fund is excellent adventure, that's kind of that on steroids, isn't it? Because I'm going to do 3x leverage of that, 3x leverage to UPRO. And I'll give me a little bond exposure in case all crap hits the fan. We'll do 45% of TML. Now, is this fund that I do, hedge fund is excellent adventure, is it guaranteed to make money? Oh, absolutely not. But it will do really well when the S&P 500 does really, really well. So I like it. Kind of like it a lot. That's why I would probably put $100,000 in. If I lose all my $100,000, would I be upset? Yes. But is it going to mess with me in any way? No. It's not going to mess up my life anyway. So I'll commit a portion to that. I think that's what I'm going to do. Now, the problem is, y'all know how I like to overtouch stuff. And I'll probably go in there and I'll probably be selling covered calls on my UPROs and do it. Who knows? And I'll probably run this since I have such a high bond position. There's no need to do black swan hedges and VIX hedges and all this other kind of stuff. Just let it run. Just let this run. So I'm really excited to do that. I think that's going to be really, really, really cool when we set that up. Any questions about that at all? Any questions? Kind of like it because it gives us something else to look at, right? So let's see what the market's doing today. Where's my AD line? Now, just because I got to get out of this account, what I do like is this account, since it's in my name personally, I do have real-time data, which is really cool. So this is a different account, and I'm not sure why it's not showing my little AD over there. But let's just kind of look at the market, and it doesn't have my 15-minute opening range. I would close it out and everything, but I don't think we have to. Oh, and I bet it doesn't have my. Where's my? Oh, gotta get all my other stuff in here. All right, let's look at our screwdriver for the day. See what it's doing. Unless I close this out. I guess I could close this out and open it back up so we can look at our stuff. Hold on a second. Close this and I'll get back in. So we'll go screwdriver. While that's opening, let me go back into this other account. Hold on. Hold on. All right, let's see what our SKU's doing. Well, our screwdriver won't work unless this is open. Come on, baby. Install your updates. I got to figure out how to link all these accounts so we can just switch from one to the other. Hold on a second. Let's see what this one is. All right, now let's get our screwdriver. It should be working now. I said it should be working now. So 3/11 is our day, 29 days. Let's see where this is at. Oh, we're coming down quite nicely, aren't we? If this is correct. 520, 520 is 80. About 80. Y'all get anything different? Let me know. So our screwdriver is at 80. Let's check that out. Come here, screwdriver. So it's going down a little bit. It's normalizing. It's normalizing. Let's see what it looks like. Yeah. So it's starting to go down a little bit. We expect it to go down a little bit here. What would that mean? That means that the market would be chilling or going higher and going sideways for the next few days to get it back down in this area. Remember, we said, hey, if you are selling puts, I mean, if you're out here, that's a great time to sell them, isn't it? Great time to sell them because we would expect prices to normalize and start heading back up. It's kind of cool. Just close that. And let's see if we can look at our little graph now. Where's my, here's our ES. So what's ES doing? Boy, we took a big old, that must have been when the CPI number came out or something. Look at that. Wow, boy, we recovered off that, didn't we? So price is oversold for the fair value above us. That's what it is. Isn't that what it is? Oh, Bobby, oh, Bob. Oversold. Here's overbought, oversold. So what am I seeing here? Not a lot of anything. It just looks like it'll probably pop in here for a while before it decides if it truly is oversold for the fair value above it. Let's see what our NASDAQ looks like. NASDAQ. So it is overbought. Here's our point of control. Wouldn't surprise us to see some movement back toward that to fill these little gaps, go back toward the point of control. So we'll see. We'll see what it does. Let's go back to the E-minis again. Have my field fans done anything good? My field fans telling y'all anything? See my fan there? I like using them. Not exactly sure what they do. That's kind of cool. All right, so let's see where our portfolio Greeks are today. I think we were down a little bit today. Yeah, down 469. Let's see what's moving. TMF is down, and the TQQs are both down. Check that out. VIX, E-minis, micros are doing good. TQQ's down a little bit. So let's see what we got. We got positive theta, which we like. Our deltas are still muted, and our Vegas very, very, very manageable. Again, there's nothing for me to do now. I'm just letting us kind of slowly and methodically kind of rebound for the year, and we're kind of doing that slowly but surely. Good. All right, let's see if there's anything else we need to do. Let's look at our macros. I always like to see where I should be closing these things. Remember yesterday, day before yesterday, we started just going through them to see if I had to take risk off, where can I take risk off? So we've got some of these macros that expire in 8 days. And a lot of these we could close now for significant profits. But I like it that they're giving me a little bit of positive theta. I like it. They're giving me a little bit of positive delta. This one we looked at the other day. Remember, I sold it for 21. I could close it for 260. That's a nice little profit. Here's another one that we sold for 21. We could close it for $3. Those are really, really, really good. And I can't wait when I get a little more buy power and put a little bit more of these in. And it's coming. It's coming. Everything looks really, really good there. All right. Anyone else got a suggestion for my 116,000? I think the hedge funding excellent adventure is going to be fun. I'm looking forward to running that. There is a little bit of me that goes, Bobby, just put it all into TQs and let it run, baby. If we were to have a March 2020 Corona crash, I would do that. Y'all think I wouldn't? I'd put all 116,000 in. I'd shove it all in. And so let's go at 100% on the TQs and see where that goes. All right, good. So we're kind of, you've been noticing, we're not over trading, we're not over managing, we're just letting things kind of work. All right, good day, y'all. Hope you have a wonderful day. I will see y'all tomorrow.